The question is everywhere. In YouTube thumbnails, and financial news headlines, in conversations with friends. What are the best stocks to buy right now? It implies that there's a secret list, a handful of magical tickers that are guaranteed to go up, and if you just knew what they were, you'd be set. This quest can feel urgent, like you're missing out. But this mindset is the single biggest trap for investors. The truth is, there is no universal best stock. What is best for a retired person looking for income is terrible for a young investor seeking aggressive growth. And anyone who claims to have the definitive list is usually selling something. So, let's reframe the question. Instead of asking what are the best stocks, let's ask how can I find the best stocks for me? Today, I'm not going to give you a list of tickers. I'm going to give you something infinitely more valuable, a fisherman's net, not a fish. I'm going to walk you through my own practical, step-by-step process for uncovering quality investment opportunities that fit your specific goals, so you can build a powerful watchlist on your own terms. The foundation of this entire process is having a clear investment philosophy. You can't find what you're looking for if you don't know what you're looking for. Before you even open a stock screener, you need to decide what kind of investor you are. Are you a growth investor, seeking companies that are expanding their revenues and earnings at an above-average rate? These are often younger companies in tech or innovative sectors. Are you a value investor, hunting for bargains, companies that the market has undervalued, often with low P/E ratios and solid assets? Are you a dividend investor, focused on established, profitable companies that pay you a steady and growing income? Or are you a blend of these? There's no right answer, only the right answer for you. Your philosophy acts as a filter. It immediately disqualifies 95% of the stocks in the market from being a best stock for you. If you're a dividend investor, a high-flying tech stock that pays no dividend isn't for you, no matter how much hype it has. Defining this is the most important, and most skipped, step in the entire process. It gives you discipline and prevents you from chasing every shiny object that crosses your screen. Once you know your philosophy, it's time to go from the abstract to the concrete. This is where the powerful tool of a stock screener comes into play. A stock screener is like a search engine for stocks. Instead of searching for a specific name, you search for a set of characteristics. Every major financial website has one. Yahoo Finance, Finviz, and your brokerage platform like Fidelity or Charles Schwab all offer robust screeners. Let's make this practical. If you're a value investor, you might set your screener to look for companies with a P/E ratio less than 15, a price-to-book ratio less than 1.5, and a dividend yield greater than 3%. You hit search, and the screener spits out a list of companies that meet all those criteria. If you're a growth investor, your screener might look very different: to revenue growth greater than 15% per year, earnings growth greater than 20% per year, and perhaps a higher P/E ratio because you're willing to pay for that growth. The screener does the heavy lifting of sorting through thousands of stocks to present you with a targeted, qualified list of candidates. This is how you find ideas that the financial media isn't talking about. This is how you do your own digging. A pro tip is to start with just 2 or 3 criteria. Don't overcomplicate it. You can always add more filters to narrow the list down further. A stock screener gives you raw data, but the best investment ideas often come from observing the world around you and doing qualitative research. This is the second pillar of idea generation. Pay attention to the products and services that are taking over. Is there a new software that every company in your industry is starting to use? That's a potential investment idea. Is there a consumer brand whose products have a cult-like following? That's a potential investment idea. This is the invest in what you know philosophy in action. Once you have an idea from the real world or from your screener, you need to go deeper. This is where you become a detective. Read the company's annual report, known as the 1OK. You don't have to read all 200 pages, but you must read the business overview and management's discussion and analysis sections. This tells you in the company's own words what they do, how they make money, and what risks they face. Then, Go to sources like Seeking Alpha or The Motley Fool. Don't just read the bullish articles, actively seek out the bearish ones. What are the smartest people saying against investing in this company? Understanding the bear case is more valuable than reinforcing the bull case. It stress tests your thesis and prepares you for the volatility ahead. If the bear case seems weak or irrelevant to your long-term view, your conviction will be stronger. Now, let's talk about the elephant in the room: market timing and hype. The phrase "best stocks to buy right now" is often code for what's hot and going up right now. This is a dangerous game. Chasing stocks that have already had a massive run-up is a recipe for buying high and selling low. The true best stocks to buy are often the ones that are temporarily out of favor, misunderstood, or simply boring. They are the ones you can buy at a reasonable price and hold for years. A common mistake is conflating a company's quality with its recent stock performance. A great company can be a terrible investment if you pay too high a price for it. Conversely, a good company going through a temporary rough patch can be a fantastic investment if you buy it at a discounted price. Your goal is not to find what is popular now, but to find what will be valuable in the future. This requires independent thinking and the courage to go against the herd. The media's best stocks now are almost always a lagging indicator, telling you what has already happened, not what will happen next. Before we conclude, it is my absolute duty to provide a serious and clear disclaimer. The search for the best stocks is inherently speculative. Even with the most thorough research, you can be wrong. Companies can face unforeseen competition, technological disruption, or economic downturns. The stock market is unpredictable in the short term. This video is for educational purposes only and is not financial advice. You must do your own research and consider your own risk tolerance before investing. It is highly recommended that you speak with a qualified financial advisor. The strategies discussed here are for the portion of your portfolio dedicated to individual stock picking. The core of most investors' portfolios should remain in diversified, low-cost index funds and ETFs to manage risk. So, to bring it all together, finding the best stocks for you is a process, not a destination. It starts with defining your personal investment philosophy. It leverages the power of stock screeners to find companies that match your quantitative criteria. It requires qualitative research, reading real-world trends, and understanding both the bull and bear cases for a company, and it demands the emotional discipline to avoid chasing hype and to focus on long-term value instead of short-term noise. Your mission is not to find a secret list, but to build a watch list of 10 to 20 high-quality companies that you understand deeply. Then, wait patiently for the right moment when the market offers you a good price on one of them. This is how you move from being a passive spectator to an active, confident investor. Now, I'm curious, what is your investment philosophy? Are you a growth, value, or dividend investor? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.